just want to get your sense of the sell-off that we're seeing and how you'd categorize it. Is this giving that we're at a bottom? Is this giving that we're about to enter into a bear market? Where do you see it heading?
So it's not your classic complete risk-off sell-off. You are seeing some of the defensive sectors outperform. You're also seeing energy outperform. Financials sort of outperforming, treading water around flat for the day. It feels more to me like people are shedding what they feel like are the most expensive parts of the portfolio. Seeing some of this in the credit markets too. One of our big calls this year was we wanted to be underweight credit risk in the portfolios. High yield, which had been very expensive. Corporate bonds look very expensive compared to treasuries, for example. And people are starting to sell some of those more expensive positions that might be exposed. Not necessarily the most economically exposed in the case of technology, but the ones that they feel like, I'm not sure what I'm getting when I'm paying this higher price for this asset.
So what do you buy in this environment?
Treasuries are one option, right? Yeah. We talk about high quality bonds. If you look at the stock market compared to the bond market, even after the sell-off we've seen, this is one of the most expensive S&P 500 levels we've seen compared to cash, compared to bonds, really since the height of the tech bubble. So investors shouldn't be shy about looking, is my portfolio out of balance? We talk to moderate investors who are maybe more allocated like aggressive investors right now because they've let the equity market sort of take their portfolios in that direction. Rebalancing at this point makes some sense. Even if you feel like you're buying a very defensive asset, at least you're positioned for a slowdown, which may be what we're ended up seeing.
Adam, come into the conversation here, because I know you're buying at these levels.
Yeah, I'm buying. I mean, I look at some of the AI stocks, Celestica as example, 15 times earnings with 30% growth. NVIDIA, cheaper than the S&P 500, 19 times earnings with arguably 50 to 75% growth. To me, that's value. They're growth names that have started to look like value names. Do you find anything else like that, growthy names that are looking like value names today?
So I don't cover individual stocks, but one thing we came into the 2025 kind of feeling like we had gotten a little bit overextended on some of the kind of Mag 7, heavy tech, heavy growth names, obviously anticipating not quite what we've seen in terms of the pullback, but being overweight more kind of value names. Financials is one area of the market that we liked. If we're going to come into sort of a slowdown, that may be one area where we're looking to trim.
Yeah.
But especially if rates are coming down, or at least steadying.
If rates are coming down for bad reasons, it's going to be bad for the banks, right? We're looking at earnings season. One area that we thought was kind of overextended coming into the year was tech ex Mag 7, where it seemed like there was a lot of expectations for earnings growth. Our big theme for the year was great expectations. We thought expectations for earnings were too high. We thought valuations were too high. We thought expectations for what the Fed was going to be able to do with rate cuts were all too high, and maybe investors came in with a little bit of euphoria. So again, anywhere where we can be on the other side of that trade, and it's worked well so far, but at this point we have to reevaluate. Do we want to be in cyclicals with the economy apparently slowing down? Do we want to be in higher growth names that are still in many cases more expensive than the S&P 500. Those are the areas where we're kind of trimming back.
And you said that cyclicals are more at risk if we do enter a recession.
So we're not seeing that today. This is it doesn't feel like a classic recession day, right? Energy stocks are kind of leading the way here. Even with the Dallas Fed manufacturing survey coming out, that's going to be very energy heavy. With a lot of pessimism, you're still seeing energy stocks, you're still seeing commodities up for the day. If you get a genuine cyclical slowdown, that's not going to be the place to be in the market either. It's going to be pure defensives.
I know that a lot of our audience is interested in finding a way to hide out in some of the big tech names, and we just had a chance for our executive editor, Brian Sozzi, to speak with Lisa Su, the CEO over at AMD, about the future of AI. Here's what she had to say.
There is no question we are in the very early innings of AI. Now, put some of the noise aside. So I am a big believer in this is the very, very early part of AI. The need for compute continues to be immense. We see that throughout all of our customers globally, and we're going to continue to invest strongly in this area because I think this is the single most important technology. I like to say it's the single most important technology of the last 50 years.
Do you agree with that from an investment thesis perspective, that long-term AI is the transformative technology to invest in?
So we get asked about thematic investments all the time. People want long-term investments, and the problem is there's a mismatch between what investors will tolerate in the short term in terms of market volatility and what they want to achieve in the long term in terms of the returns. Absolutely, AI is going to be transformative, has been transformative, potential for productivity breakthroughs, handling potentially lower labor force participation, older workforce, and having to find other ways to kind of make up for that problem that we're going to have the next 10 or 20 years is going to be transformative. A lot of these stocks, I think, when push comes to shove, if and when we do get a genuine slowdown, we'll do better because they have a secular kind of earnings story, kind of powering their company's sort of the bottom line for revenues, their outlook long term. But in the near term, if they're perceived as sort of this is something that's done well lately, it's been a high momentum trade, anything that when this hits the wall, anything that's kind of high momentum is going to be suffering. Whether it's a consumer stock, whether it's a bank, whether it's an AI-related trade. So in the near term, this could be dicey. Long term, we're big believers, yes.
Yeah, I love that difference between long-term expectations versus short-term emotions, right? People are long-term investors until things get rocky and they say, well, I'm not sure. How do you tell your clients how to play through that short-term chop?
Some of it is we try to allocate as much as we can to alternatives, could be private markets. One of the things we had this year, we thought real assets were going to do well. They have done well, but we wanted to play that more in the private side because we know there's a lot of volatility. If you buy things like a commodities fund, a gold fund, gold's obviously been very good, but it can be extremely volatile. Playing more of that on the private side where you have to deploy capital over time slowly and you're getting those returns back over time slowly, it makes more sense to us than something that requires you to stay in the markets through thick and thin, which we know human brains are not necessarily tailor-made to do.
Right, putting a little bit of that emotional EQ into the
Try to put as much of it
plans.
aside as you possibly can.
Yeah, all right. Thank you so much, Brian. Really
Sure.
appreciate you joining us in studio. Thank
you.
you so much.